following is a paid commercial program paid for by McClure Capital Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host. My co-host, Guy Allard. How you doing, Guy?
What's going on?
We're here at the Dallas Cowboys headquarters at the Star in Frisco, our new location for those of you who have not heard the show in a couple weeks. They had OTAs, which are, what are they, organized team activities or something like that? It's before training camps and all that start out in, Oxnard. And so it's been a little exciting over here, a lot of people buzzing around.
I see families camped outside there with their little guys. I'm talking a year old, 18 months old, 2 years old, with a cooler, and they got the lawn chairs out across the street, looking between the bushes to get a little sneak peek at the players. It's pretty cool.
I know. I was looking at the players. They got their parking lot behind us, and I'm like, that's going to be really hot later on. We're parked in the cool underground parking garage.
Their Lamborghinis are out in the sun, and your Ferrari's in the nice shaded garage, right, Vic?
Remember, we developed this show to answer your financial questions. What we found is a lot of shows out there, a lot of different financial shows were just a commercial to buy an annuity or a commercial to buy some managed program, but they really weren't teaching anybody anything. They weren't giving you information you can use right now. So to me, after listening to one show, maybe two, I've learned everything I need to know about them. Hopefully, we've tried to make this show different. So we try to give you things that you can use right now. Obviously, we do this for a reason. We want business. We do it. We created a pretty successful business here in Dallas from it. But I still would like to teach people if they don't have enough funds or whatever, I still want them to listen and learn something. And so, because if you do your finances correctly, life just gets a lot easier.
Well, and there's a lot of folks, face it, that their main concern, as it should be, is their job and their family. They don't do finances day in and day out. Probably, if you've got kids, you know how hard it is to save over and above the kids' expenses and the schools and the mathnasium you were telling me about and all the stuff that you can do. So what do? They put as much as they can. They max their savers. They max out their 401ks. A relatively simple choice usually, right? Limited choice, simple choice. Hopefully they get some direction. We can help if you would like. We're more than happy to do that. We've done it for a lot of folks. And then they have the payroll deduction. And then all of a sudden, you wake up and you're 60 years old, 63, 64, you're going to retire or two. What are you going to do with this money that you've saved? You need a little help. Again, it's not something they do all the time.
Yeah, it's funny. I just got all the bills for the summer camps and all of those kind of things. And, the training camps and the summer programs for, there are 4 children. One's 31 and the other 3 are younger. And they're all into sports and this and that. And, oh, my gosh, you got to have the sports. You got to have private coaches. You got to have all year-round basketball. All up. Like, what? Used to, you had seasons. You went to those seasons, and that was it. Not anymore.
I remember growing up and playing sports, whether it was baseball. Basketball, you didn't need a lot, right? Just the basketball and some shorts and T-shirt. Maybe the tennis shoes. Remember the Converse All-Stars? No. But it was a big deal. I don't know, 30, 40, whatever it was to get the gold-colored Converse All-Stars that matched our black and gold Cassville Wildcats down in Missouri. But it was hard to get the $30 or $40 for the shoes. Not hard, but your parents certainly made it seem like a big deal, right? And you're paying what for one child? $400 a month for mathnasium or something? Where did we go wrong?
Well, I took I remember buying all the football gear and everything for one of my sons. First game, he gets out there, sits on the field and starts crying. The stands are full.
You're the younger one.
Yeah,
right?
I've got to go walk out there and get him.
Is that when he was saying, please don't hit me, Daddy?
You're not going to spank me, are you? I'm like, oh, Lord. The whole thing was like, the mayor was laughing at me, pointing at me. I was like, okay, this is great. I've just spent a couple grand, it seems like. I don't remember what it was, but it's got all these pads, and I had to give him the fancy stuff. You didn't want the rickety helmets. Got to get the real good one. And so it's been sitting in the garage ever since. It's never moved. But there's more and more as that stuff comes along. People ask me, what is the state of investing right now, the state of investors? Well, obviously the market's done pretty good. It hadn't gone down in 8.5 years.
Is it losing its breath?
It's made, what, 10% this year?
Oh, I know, or 15.
The one thing that I always tell people there's something they've been saying for hundreds of years, and that's buy low, sell high. It's one of the hardest things in the world to actually do. Your brain says to do it, your logic says to do it, but your heart says no. Let me give you an example. Market's up right now. When's the best time to sell something? It's high. Just like your house. I don't want to sell my house. It's going really high, right?
180-degree different way to say buy low, sell high is you buy into the weakness, right? And you sell into the strength. Right now, the market is strong. It's an ideal time to take some off the table.
It's almost impossible to do because of human nature. You know, think about it the opposite. Market loses 50%, right? You just lost half your money. I'm going to put more in. This is when I really need to double down. Very few, the ultra wealthy do that. The average person, psychologically, financially, it makes it extremely difficult. It's kind of like we're talking about people right now are having a hard time because they're complacent. Well, why would I want to fix something that's not broken? It's fine right now. Why would I got to change anything now? I go, well, think about it. Think about yourself when you were 25. You're 25 years old. You're running every day. You're playing basketball. I didn't have an ounce of fat on me. That was a long time ago, folks. I didn't have an ounce of fat on me. And they tell you, you need to go get a colonoscopy and go down to the doctor and get a physical. I'm like, get out of here. I don't need, what do I need? I'm 25 years old. Now that we're in our 50s,
bulletproof.
We don't miss those kind of appointments. Now we're always thinking, oh gosh, do I got cancer? Remember that Seinfeld? Lupus, I got lupus. I know I got lupus.
All right, I got to digress real quick, and then I've got a point I wanted to make about taking some off the table, but I can't resist. Victor, I'm thinking it was 2 years ago, went and got his colonoscopy, and he was just a hoot. And you got to tell him, picture this now. Victor's got the gown on. They've already given him some of the juice to put him under. They're rolling him into the room where they do it, and they're closing the drape. And what'd you tell him, Victor?
Well, I had a endoscopy and a colonoscopy at the same time.
Okay.
Doubly joy day.
Sweet.
So I was doing both. I got this chalk in my mouth. They said, put your knees to your chest. And I'm not getting graphic here, I promise you, folks. And all of a sudden, I said, wait, I'm still awake. Don't start yet.
Did they all start
laughing? All
laughing?
started laughing, and that's the last thing I remember.
You know, we talk about numbers a lot, so I'd throw some numbers just to confuse you a little bit. We always talk about selling into the strength. You buy low, you sell high. But some real motivation for you. We always talk about having a plan, having your income taken care of. You're going to have X amount in inflation hedge the market. You're going to have X amount maybe in an annuity or a bond to give you income. You're going to have your safe money throwing off a good yield rate. You've got your pockets. You've got your plan. And you have to stay within your plan. If the market has gone up let's say 10% this year, and you had $1 million, now you've got $1 million in the market. Now you have $1.010 million in the market. If you're 50, they say you take your age from 100, rule of 100, how much you should have at risk. So you should have 50% of that at risk and 50% of it protected. So now instead of having 500 and 500, right, you've got 600 in the market because it's grown, and you've only got 500 that's protected. So if nothing else, just to keep your plan honest and to stay on track and not get greedy, you need to reallocate and take some off of that high growth. I know it's hard, it's counterintuitive, it's difficult, but if nothing else, you have to rebalance.
Look at your portfolios right now. That's a good exercise. The easy way to do it is whatever your age is, that's how much you should have safe. Now you can vary, 10% here and there, but if you're 60, you should have 60% safe. If you have 90% safe, you need to look at something, especially after 8.5 up years in a row. Remember, the market's never made 9 in a row. It's amazing to me that people, they're always the same. They always behave the same way no matter what. Think about it. Market went down 50% 2000 to 2002. Ooh, next time that thing goes up again, I'm gonna do it right this next time.
I won't mess
goes
it
up till 2008. You didn't do it, of course. You watch it go up, then you watch your money go down in half again. Now we're telling you again. It's been 8 or 9 years. I don't know. I've been telling you for a couple of years it's due for a correction, which is absolutely true mathematically and by the valuations of the stock market itself. I go, but you're going to do this exact same thing again because everybody does. But you're like the 25-year-old that doesn't want to go get a physical, but now you're 55. You've already been through this 2 or 3 times. You're wiser and everything else, but psychologically you'll do the same thing. So if I can convince the listeners of anything at all, consider taking some off the table, because if it turns, each down year can delay a retirement up to 5 years. One down year up to 5 years. Last time it delayed people 8 or 9 years. And so don't hesitate to call us if you have any questions. We'd be more than happy to talk to you about anything you've got. 972-715-2424. Again, 972-715-2424. You can always go to our website at ilovemyretirement.com. We'd love to see you at our new office at the Star here in Frisco. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. We were just talking about the break before. Oh, by the way, if you have any financial questions, don't hesitate to call us. We just got our website, got it revamped a little bit. It's at ilovemyretirement.com. And give us a call at 972-715-2424. Again, 972-715-2424. Right before the break, we were talking a little bit about rebalancing portfolios. It's hard when something's doing well to do what you kind of logically know you're supposed to, and it protects you. Think about it. The people that lost all that money when the text dropped 80% or so in 2000, they didn't start with 80% tech stocks. They might have started with 10% tech stock. Now, they might have added some, but what happened is they outperformed the other sectors so badly that you ended up by 1999 with 80% tech stock. So you took
all of your money magically migrated over to the high-risk tech stocks that were doing so well.
You didn't want to change anything because, wait, that thing made 30. That tech fund made 30% last year. You think I'm going to take some out of that and put it in this 3% money market? Are you crazy?
And think about it. There's an old commodity phrase, and we used to do managed commodities for the high net worth individuals, and it says, or it goes, pigs get fed, hogs get slaughtered. And the point is not to be a hog and not to be too greedy. And again, we understand it's intoxicating. You're doing well. It's like being on a winning sports team, right? You're racking up the points.
Go.
Woo! I'm not going to bench my lead shooter, but you can wear them out and get tired. In the scenario where Victor's talking about back around 2000 when the techs and NASDAQ was high flying and doing so well, if you had the discipline to keep balanced, which is what we're talking about today, it's not as hot and crazy now as it was then, but it's a long-term bull market right now. But if you would have done the right thing back then, sure, your tech stocks would have been down 60 or 70%, but that would have been a portion of your portfolio. All a while along, you were rebalancing. So your conservative stocks, your income generator, all of those accounts were growing equally with the tech stocks, but you've been rebalancing. So when it crashed, you still have large accounts over here, and it was just your tech section that went down. And it's the same thing now. It's, again, the market's not as hot, but if you rebalance and you take care of your income that we talk about, and you take the money out of the high flyers, the 10%, and rebalance it, when the market corrects, that part of your portfolio no doubt will go down, and it will go down. It'll happen. Don't know if it'll be this year or 3 years from now, but you were the smart one. You were cautious, you were disciplined, and your other accounts will be larger if you do the right thing.
Think about it. This is the last analogy I'm going to use, but I've seen this so many of those movies about gambling and things, where you see the guy and he's hit it huge. He just kept let it ride. And they're saying, no, why don't you stop here, pull
some back.
Yeah, does it say to pull some back? Have you ever done that where you're playing blackjack? Where I'll pull the seed money back and I'm only paying on their profit. So even if I lose all of it at the end, I've only lost part of the profits. Instead of, would you do that? Would you take every bill you've got, put it on red, and if it wins, oh my gosh, not only can pay the bills that month, you got extra money, double the money.
Let me throw something crazy.
But you keep going and keep going and keep going. At one point, you got to say, hey, pull it off. And
Let me throw a crazy idea out there by our listeners. What if this great 8-9 year bull market has given you enough money where you could generate income with what you've got right now to last the rest of your life to meet your requirements? Do you know what your requirements are monthly for the rest of your life? Do you know if you have enough money so that you won't run out till you're 100 years old? Do you know how much money that need? Is it $1 million? Is it $2 million? Is it 500? Do you know what that number is? If you don't, give us a call. It's easy for us. We can do it with you on the phone. We can start the process. We can let you know taxes, all of that stuff, all that rigmarole figured in, and let you know roughly at what point you'll run out of money or how much you'll have when. It really sheds a lot of light. I think it would be a good thing.
Our number is 972-715-2424 or go to ilovemyretirement.com. Think about this. All you got to think is I'm a logical person. It's all math to me. I try to keep complete emotion out of it. Very difficult to do. And that's one
especially
of the main
when it's your own money, right?
Oh, absolutely. Very difficult to do. So sometimes you have to look and have an analysis done, even if it's a cursory analysis, to see, okay, I've got this much money, bull market's at 8.5-year high. What if I peeled off this piece, 25%? If that piece could guarantee the rest of your life, in other words, 75%, you're going to let it ride, you got to keep going. But that can guarantee for the rest of your life, you will never have to change your lifestyle, not 1 inch.
Does winning the lottery look any better than that?
Right, and I didn't win again, by the way.
I didn't win either. Damn it.
But see, what I'm saying is, we can answer that for you. Just taking out what percentage of this piece will protect me for the rest of my life. Does it make sense? You can still ride 75, 70, 65% or whatever, but you just guaranteed your lifestyle with one piece.
You may have already won the lottery. You may have enough.
If you don't save another dollar, if the market never goes up, goes down forever, you're covered. So it's be kind of like, I don't know, you're making a bunch of money and you take part of it and pay off your house. But this is a lot more important than your house. Your retirement funds you have to live on for possibly 30 years or more. If your spouse is younger than you, you're talking about even longer than that. So that's why it's extremely important to, when you have a time like we have now, rebalancing, number one, but also take a look at it. Have someone look at it. We hope it's us, but have someone look at it to say, is there a possibility right now to peel off a piece and guarantee a portion of my lifestyle? Let's say it's hard expenses, whatever that number is. And that it always does. Because what happens if the market does go down 40, 50%, it's too late. Now you'd have to use 100% of your money, if that's even enough. Call us at 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com. Stay with us, folks. We're going to break coming up. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. All right, let's go to a different topic now. The Department of Labor rule, the fiduciary rule is what it's called, has gone into place. Actually, as of the time of this recording, it's gone into place. Unless some miracle happens and they get them at the 12th hour. And nothing wrong with the Department of Labor rule, except there's so many unintended consequences. What it basically is saying, everybody should have a fiduciary responsibility with their money. Most people already think they have that with their advisor, but it's only registered investment advisors that have that. We happen to be a registered investment advisor, and so we've been operating in that space for a long time with a fiduciary role, putting your interests ahead of ours, all that kind of stuff.
Explaining all your fees and
That's right.
commissions and if they're involved. And
so we already act in that capacity. But they've made it where any product, any time that's into a retirement account, the problem I have with it is the SEC controls it, the state securities boards, FINRAs. There's so many government agencies already there. Obama wanted something done, and they said, we've already got these guys with 3 or 4 government agencies. If you ever ran a business and had one government agency that monitors you, it's terrible. Try 3 or 4. Well, now there's another one. And what happened was Perez, which was the DOL chief at the time, now the head of the DNC, was the only one that said, I'll do it. And so they embarked on that. And I like that it's a noble cause. I like the cause, but the unintended consequences could be bad. England did it a few years ago. Now nobody will touch an account under 500 grand.
Yeah, I was going to say, especially if you have a smaller account.
There's already record numbers of orphan accounts. They just let them go. You bought something from this firm. It could be a big firm. Now nobody will handle your account. There's too much liability. They don't want to handle it anymore. So the people they're trying to help, the very people they're trying to help, are now have no financial advice whatsoever. The lawyers can sue retroactively. In other words, if you got in the market and the market went down, well, obviously that shouldn't have been a suitable investment. You say, I can't foretell the future, and they say, well, that doesn't matter.
Yeah, and the idea is they're going to have the attorneys police the industry, and that's never fun.
So hopefully the SEC will come in and make a real fiduciary rule that really counts.
Has some teeth
Something,
as well.
yeah, that doesn't just cover retirement accounts, all that kind of stuff. We already do 90% of the stuff. It just added about, 10 pages more?
10 pages
paperwork.
per customer. That's
now,
right.
remember, it was already about 20 to 25 pages. It used to be 2. But all the Dodd-Frank came in there. They did that giant piece, right?
Yep.
Now this, and it's, like I said, when you're buying an investment or starting it's like buying a house. You know, you got to fill out 1 million forms, and they just made about 10 or 15 more.
It's like the Dodd-Frank in as much as, there's the heart of it's good, and what they want to do as far as protecting the clients is very noble and right. But when the government gets into anything, there's more red tape. It's 10 more pages, and inevitably, and Madoff is probably the best example of that. It was ahead of what exchange was it?
Yeah,
NASDAQ, and it never really does what it's supposed to do. But yet you have all the peripheral crap that goes with it.
Oh yeah, there's like Obamacare. Everybody knows I'm no fan of Obamacare, but it had a noble cause. Let's insure this few million people that aren't insured, and it did some of that. The problem was it screwed the other 90%.
Yeah, the people that were working.
Right. So it has unintended consequences. That's why these things are so difficult, to come up with legislation that actually works across the board. My always thing is if you get too much regulation, it's like I was in California, my old Navy base in the Alameda. We're looking there, and this place is a huge place. You can see San Francisco across the bay. So it's perfect land. I mean, they could bulldoze these old buildings because remember, the last 8 years or so, they've pretty much demolished almost every base I was ever stationed at. And so they got all these empty buildings on prime real estate. But because there could be lead in the paint and asbestos in the thing, these are empty warehouses. I mean, hundreds of acres of them. And California is much more left, obviously. So the thing is going, usually somebody just, in Texas, we just have bulldozed that whole thing. And we'd have built high-rises right on it, right?
That's right.
There's no question about it. But there, it's going to sit there empty for eternity because the regulations are so strict, it might cost you $10 billion just to put it down and then to build it up. Remember, with those kind of regulations, the cost of building. A bricklayer in Texas might cost you $10 an hour. It's $100 an hour there. Got to have labor. Got to have a union bricklayer. Those kind of things. So the unintended consequence of all that regulation is going to help. So that's the last I'll say about. We already do almost all of this stuff. For us, it's like 1 or 2 more steps, which doesn't bother us. But I just want to be honest with you. There are unintended consequences to every kind of regulation. And
if you have any questions on what's going on, or if your account falls into that $500,000 range or so, and you're not quite getting the service that you should get, we've always been rated number 1 in service. Continue to be. And again, just call us 972-715-2424. Be happy to answer any of your questions and help you.
And it's already, my cousin works at a big firm here in Dallas. I'm not going to say which one. But if you're under $2 million, you go to the bullpen.
Oh, yeah.
That could be a 22-year-old whoever learning on your money. I don't think that's fair either. But do you think that's going to get better or worse? Obviously worse. Stay with us, folks. We got a break coming up. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
That's right, plain-spoken, no-nonsense, probably because we don't know how to speak any other way. Guy is much more...
much more what?
Not as
better looking, obviously, but other than that.
Challenged as I am anyway. I had some customers in the other day, and I said, I think I'm the only person on the radio with a hick accent that's not on some country station. They go, well, that's why we listen to you. I'm like, okay.
All right. You just have to start wearing your cowboy hat.
I always told them, I said that, hey, I'm saying this to be self-deprecating, but I've never heard a very heavy accent that sounds like a Rhodes Scholar. I'm just saying.
I don't think you got the accent you think you do, but I think I'm
That's
going to
good.
start doing my Imus impression, and I'm going to start wearing my cowboy hat when we record. What do you think?
No. I think it's a New York guy trying to be a cowboy, right?
Oh, he's got a ranch in Wyoming for kids, and he does a lot. But yeah,
All right, remember we designed this show to answer your financial questions. Anytime we get questions that I think is going to appeal to a broad audience, we change the names or don't use the names to protect the innocent. But we're going to bring them to you, and hopefully you can learn a little bit something from our answers. All right, what's our first question?
all right. First question. It's a political question.
Oh, boy.
Do we dare go?
Go ahead.
All right, let's do it. How does the White House's tax proposal affect us here in Texas?
I don't know everything about the president's tax proposal.
They don't know everything about
No,
the tax
nobody does.
proposal.
All I do know is I've never seen a president's tax proposal, a third of it ever go through anyway. It's just kind of like a wish list.
Yep.
But some of it could be good. Some of it a little scary, like they're talking about getting rid of the sales tax deduction, maybe your retirement deduction, your real estate deductions, real estate taxes.
And depending where the actual cutoffs are in the brackets, you could actually, if you're upper middle class, you could end up paying more in taxes.
Oh yeah, I think we were looking at that before, and I think I want to pay more.
That's right.
So they're tax cuts.
Getting rid of
But they-
alternative minimum,
They have like 3 tax brackets instead of 7 or whatever.
You know, I keep hearing, and you tell me your thoughts on it. I keep hearing them talk about on the news shows and all that, the senators and the congressmen and the Republicans saying what we want to do is get this down to just a 2-page form that you can do on your kitchen table. And I don't see them getting to that. You know, we got so much going on, and
Like 900,000 pages of tax
I
code.
know. But I mean, that's what they're trying to do. But I don't see them getting in that direction yet.
Well, the one thing that I thought would affect something, it's not even just financially, but it's politically. There's a whole bunch of things. One of the things is you always had that state tax deduction. You know, you got the state tax deduction. We have sales tax deduction because we don't have sales tax here in Texas. But the one thing the people in the other states could always do is raise their taxes as much as they wanted to. California can raise their tax as much as they want to because it's a direct write-off on your federal tax.
Yeah, who does it hurt? It hurts the
That's
federal.
right.
That's right.
All they do is the Fed, it just hurts them, right?
Yeah.
The people in California don't pay any extra taxes typically because they're writing it directly off. Now, relative people, there's extra stuff. I got you. But for the most portion, they're just paying the same. Now, let's say you were paying 30% taxes. I don't know what the tax rate is in California. I'm just making it up. But say you paid 30% taxes.
State, you're talking?
State taxes.
Got it.
Your federal tax was 40. You make good money. You make a couple, 300,000 a year, whatever. So it didn't bother you, right? What happens now? Instead of the 40% taxes you're paying federal, now you're paying 70 because it's not right. Well, people can't survive in a lot of cases. I was talking to someone about like a New York cop. New York cops make $100,000 a year or so, which is not bad, but in New York,
But
it's
not
not
good.
great.
Yeah,
right?
not good in New York.
But if you're a couple making $100,000 and you were paying, let's say $30,000 in taxes, now you're paying 60, you can't survive. And so what'll happen is a lot of these states like that, people will come flooding out. There's already, look at our highways now. There was nothing in this northern Dallas area 20 years ago. Now it's booming, right? It's everything. People are coming here for that. But what is it going to be if you got a double taxation in all the states with state tax?
But
there's a far-reaching impact to that.
There's always two sides to every story or every coin. The premise of that I like. It's supposed to be self-purging. If one state is charging too much in taxes, too much in entitlements,
right.
they're not budgeting their money correctly, and they're raising their taxes, people can say, well, forget that. I'm going to move to a state that's a little bit better with their money. And, kind of like banks raising CD rates to generate, et cetera. So it's supposed to be a good thing.
Right. And don't get me wrong. I'm a conservative, fiscal conservative person. And so I understand that. But I also understand the ramifications of that.
You'll be paying more.
Besides me paying more. Somebody told me I didn't pay enough. I was like, well, half of my check goes. I don't know about how much yours goes. Usually the people are telling me I'm not paying my fair share don't pay anything. I pay very little.
Usually the people telling you need to pay more are the ones that aren't paying anything.
Right.
Oh, well, you don't pay enough.
Like
What?
these college kids at these rallies and all that stuff. They're not paying anything.
I know.
You don't really see any high taxpayers going, you need to pay more, except for sometimes the Hollywood people. But I'm telling you, those Hollywood people, those same Hollywood people, had to pay 30, 40% more. they'd be squawking too. It's just human nature.
One of the things you might want to take a look at on the taxes, and we'll know more as it gets through Congress, and then we know the senators get it, and they want to completely start from scratch all the time, like the health care. But as it starts coming together, things come into place, such as, do you need to have a Roth IRA or not? Victor and I have talked about that a number of times, and I'll just give you the capsulized version. If you're going to pay as much in taxes or more in retirement as you did when you were working, then a Roth may make sense. But if you're going to pay less in retirement, obviously it doesn't. So those sorts of things may come into play.
And they will affect your investments, your retirement, all those kind of things. The one good thing about our software package that we use for all of our clients in the retirement plans is it's automatically updated for those changes. So we can do in real time, if you're a client of ours, we've done your plan. As things change in real time, your plan will change to reflect the different tax codes that come out, or the different rules that come out with deductibility of IRAs they're talking about possibly getting rid of. And all of that stuff is automatically done.
And if you're not a client of ours, and again, it's easy for us, we can start the process, we can do it over the phone. Call us, 972-715-2424, or visit our website, ilovemyretirement.com, and we'd be happy to help you with it.
Well, stay with us, folks. We have a break coming up. We got more questions and more answers after the break. 972-715-2424, 972-715-2424, or go to ilovemyretirement.com.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
That's right. Experience is another word for old.
You don't get experience without age, do you?
That's right. Age comes wisdom and bad knees.
Wisdom is the intersection of experience and knowledge, yeah?
I was walking up and down my stairs the other day, and I'm like, I need to get an elevator in here. My kids, what's wrong? I go, well, I walked up the stairs twice today.
I remember.
So that's a big time thing.
I remember growing up in the 70s, and they were talking about Johnny Carson's house. And I remember my mom telling me once, she goes, man, do you believe he's got an elevator in his home? Yeah, I guess he does. You ready for another question?
Let's go.
This is a tough one. I've started having kids and saving later in life, and I'm trying to figure out how I'm going to pay for college and save for our retirement. I don't think I can do both. Any tips?
Well, I'm with you. You know, I was an empty nester and then had 3 more, and so remember one thing: you can get a loan for your kids' college. You can
local college. You got the junior college for the first 2 years. Oh, that's right.
That's right. But you got all the local. But is anybody going to give you a loan for your retirement? If
no.
You wake up and you're 68 and something happens where you really can't work, even though you planned on working, over half the people that planned on working past 65 can't. Wasn't their fault. They can't. Or they start pruning people off at a certain age, bring in the younger ones for half the rate.
And then what job do you find?
That's right. Now, who wants to hire you now? It's really tough. And so since you can't borrow, anybody, if you went to a bank and said, okay, I had 5 kids. I sent them to college. I know I should have saved, but I wasn't able to. But now I need money. I need $50,000 a year to add to my Social Security to pay the bills. Can you loan me $1.5 million? When they stop laughing, it's impossible once you get to that point. But like I said, you can get Texas Tomorrow funds. You can get scholarships. You can get a lot of different things, but there's nobody ever going to pay for your retirement except you.
And don't feel guilty. What's the first thing they used to, I'm assuming they still do, tell you on an airplane? If the plane gets in trouble and these oxygen masks fall from the deal, they don't tell you to put your child's on first. They tell you to put yours on first. Why? So that you're coherent and you're in a position where you can take care of your child. It's the same thing with retirement and your finances. You really have to take care of the household first, and that puts you in a better position to help.
Maybe you could do a Sophie's Choice situation where one of them you like really good, you're going to send them to college, and the other one, no. All right, but remember,
it's a competition.
You've got to if you can max out 401ks and stuff like that when you're young and don't need the extra funds before you start having kids, and make it part of your DNA.
Yep.
That's the people that end up retiring well. And kids still go to college because they're retiring. They got a lot of extra funds in there, even sometimes borrowing from a 401k, but I don't like that. But I'm just telling you, save first, kids next. I love my children. I'd do anything for them. But you cannot get a loan for retirement. You can for kids. There's answers for kids. There's not for you.
And it's not a pleasurable answer to give or receive. But, you can't have champagne taste with a beer pocketbook. It may mean driving a Toyota Corolla for you and your wife. It may be living in a 221.
In Texas, we don't have those, do we?
What's that?
2-2s.
Two bedroom, 2 bath. 2 bedroom, 1 bath.
Right.
But anyway, if you do all that, then the saving is easier.
All right. What's our next question?
All right. I'm not fond of annuities. So what's the best way to get the most income without using an annuity?
Well, it's pretty easy. You can look at the 10-year bond rates. Right now, they're maybe 3%, something like that. So for every $1 million, you can get $30,000 a year. Sometimes you can get 3 or 4% on municipal bonds, tax-free, $30,000-$40,000. Now you're going out 30-40 years. If you can withstand the large fluctuations in the principal balance, because the income, as long as they don't default, should be steady. But if you can read that, you can do those. CDs are always an answer. They're going to pay you $10,000 per million.
And I'd also take a look at this expression, I don't like annuities. It's a lot like saying I don't like cars because you had a real bad experience with a Toyota. Right. I mean, you've got the variables with high fees. You've got the index that provide income. You also have CD-like annuities that work for, 5 years or so. You can get 3.25% on 4%.
People get labels on them, and they listen to information from people that are selling competing products. Oh, that's the worst thing. But the truth is, it's just numbers. All right, I can get $10,000 from a CD income per million. I get maybe 30 from a bond per million. Maybe get 30, 40 from a municipal bond if I go long term per million. Or I can get 60 to 100,000 a year on an annuity. It just depends on what you're looking for. I don't care what I call it. All I care is at a certain point, I want to take a piece of money and I'm going to bucket strategy that thing. That's going to be my income bucket. I want the most possible income out of that bucket. I got other stuff I'm going to leave to kids or whatever. But if you can do that, that's why for the income bucket, nothing will pay you more than an annuity. But that's why I wanted to answer the question. There are a lot of things will pay you income. Everybody's this dividend stuff. The average dividend on the S&P is like 1.8%. So if you're going to live off dividends, and I know AT&T pays more, all that stuff, but you're risking a whole lot on a couple of companies.
We talked about it briefly last week. If you've got CD money and you're using that to be secure, and you get 1.5%, 2% on a 5-year CD with a 5-year fixed annuity, you get more access, you get creditor protection, and we can get you 3.25%, maybe a little bit better % return on the same money.
A lot of times, don't get caught up in labels. Just go for the math. How much is it going to pay me, period? Is it guaranteed? All right. And that's what you get. As long as it's guaranteed, it's there. And the default risk, don't buy B-rated companies on anything. That's right. Don't buy low-rated bonds. Same thing. Well, that's our show, folks. I want to thank everyone for listening today. Don't hesitate to call us if you have any financial questions or like to take advantage of any of our complimentary services. 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com. I'm Victor McClure for Guy Allett. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by McClure Capital Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.